Okay, just a reminder for Applied Series subscribers that we have 2 live sessions today, noon to 1:30 and 9 p.m. to 10:30. It's a long weekend. I don't know if many people are going to show up today. I said I would do these on the last Sunday of every month. Well, it's the last Sunday of the month. It just so happened to be a holiday. So if you're on, great. Okay, let's begin. I think most of the presentation I have here for the front end of the curve, the 1 month, the 2 month, the 3 month, is going to be rather meaningless at this point. It's Sunday at 9:03, late Saturday. I got notices from the different apps I have installed on my iPad. News services. A tentative deal in Washington has been reached. It just needs to be voted on. Could be some questions as to whether or not they can get the votes on both sides, but it's there. The market, I think, was fully expecting a deal to be reached. Just why rush and reach a deal really soon when you have cameras rolling, right? You may as well politic for a while and campaign for the next election while the cameras are rolling for free. So both parties took full advantage of the free coverage to campaign. So I expect, if everything, falls out this week, I expect the 1 month, the 2 month, and the 3 month to fall in line with where the target range is now, 5 to 5.25, and maybe even start pricing in what looks like a highly probable rate hike in June. I had written down when I did these screens, June 5th is when Yellen said that that's it for the money in the Treasury. So we'll keep June 5th in mind just in case there are some holdouts on the vote and it doesn't look like they have the votes. They have to go back and renegotiate. But as of now, it looks like it's well on its way to being taken care of. So that kind of is out of the way, and I'm sure the markets are going to throw a party for this. It'll be called a relief rally, even though the market never really sold off on it. We're going to have a relief from higher levels, meaning even higher levels. There were 2 stories that were guiding the market a week ago, and that was the debt ceiling and the Fed. I mean, that was really it. Midweek, we had 3 stories. AI showed up. And AI is starting to feel a lot like 1999. And I've got quite a few screens that will look at what's going on in that space. And I don't know that I want to underestimate the euphoria that's actually brewing there. So there were 3 stories, 2 negatives and a positive. Well, 1 negative just went away, and that negative will now be seen as a positive. Okay, well, we got a solution. Yay, that's a positive. As opposed to just not being a negative anymore, it will actually be seen as a positive. So I think going into the week, we have 2 positives and a negative. And the negative at this point, because we're so close to the end, okay, so there's one more. We're looking past that. I think it'll be downplayed. I think the market simply doesn't care. The economy is way too strong. Who really cares? Nothing has happened so far. Everyone's absorbing these rates. Sure, there were a few issues, but AI. In fact, it's such euphoria now for the Applied series. We are going to use AI tools. Not really. But if I say we're using AI tools, a larger company like Microsoft or Google might offer me several $1 billion for my business just by saying AI. I might even change the name to AppliedSeriesAI.com, MarkMeldrumAI.com, and let's see if I can increase the value of what I do by doing nothing. So money market rates, I think, will start to be more well-behaved. And capital market rates, they continue to increase. We got some Fed speak this week. Wednesday, you have Bowman, Harker, and Jefferson. You have the beige book. Let me close that open bracket here. You have the beige book on Wednesday as well. And Thursday is a repeat for Harker. Our curve inversions, the 2 to the 10 capital market inversion, negative 74 basis points. All capital market inversions got more inverted. Money market to capital market inversions continue to steepen. The 3-month to 10-year is negative 154. The deepest was 189 on May 4th. The 3-month, 18 months from now minus the current 3-month is inverted 180. Last week was 189. CDSs have been coming in. The 5-year CDS is 58.87. It was 65.66. The 1-year is 140. Was 149. I'm sure next week when I do this, these will have basically crashed. If you get a vote this week, these will have basically crashed. The balance sheet runoff, another $4 billion. That was all MBS, down to 7.662. This is just the open market account. The full balance sheet, 8.436 trillion, down from 8.456 trillion, down 20 billion. The SOMA was down 4, so the balance sheet on its own dropped another 16. Money market funds continue to pull in money, and I think they'll continue to pull in money. Retail up 7.26 billion, institutions up almost 40 billion, so another almost 47 billion went in there. There's a lot of premium, well, we don't call it premium, a lot of interest in money market rates. I mean, you're getting over 5.5% in what I would call right now a market of maximum uncertainty. I've never been more uncertain of the next move than now. To put it into context, if next week we go sideways, wouldn't surprise me. If we go up 100 points, wouldn't surprise me. If we went down 100 points, wouldn't surprise me, because there's an argument for all of them, and I have equal weight on all of them. I have no particular leaning at this point. I am so neutral. When I think about, well, maybe I'll jump on board the momentum for a while. I think, yeah, but it's looking like 99, but it is very much different than 99. But do people even recognize that it's different? Because I'm not really in a market against the fundamentals. You're in a market against everyone else. And I have said in a previous video that I feel right now that I am in a market dominated by participants that have absolutely no economic training whatsoever. So it does not help to be right in a room full of wrong people. Okay, not much on this screen here. June 14th, next FOMC meeting. That's 17 days away. In 2 days, we get the JOLTS report. 2 days from the day that we're watching this. Monday's a holiday, so it's basically the first day back we get the JOLTS report. Wednesday, beige book, as I said on the previous screen. Friday, we get the jobs report. I'm not even sure if it's going to mean anything really with the AI hype. And again, I'll show you some charts that were going on Friday. And if you were watching Bloomberg on Friday, it was all AI. Every single conversation, every single guest, AI, and that's all it was, to a point of ridiculousness. Look what happened to the odds of a 25 basis point hike. Last week was 17.4. We're sitting at 64.2. It went as high as 80% during the day on Friday. No hike, down to 35.8%. If we look at December 13th, we really see some effects here. 5.75 now has almost a 5% probability. That was non-existent last week. There was only a 0.8 at the 5.5. Now it's 21.3. So you've got roughly 26% probability of a rate of some rate hike. At least no pause, no cut, but 26% waiting on one or two, some rate hike. No cuts, no hikes, no cuts. 35.4%, up from 7.7%. And if you look at last week at 4.5 was 17.1. That's pretty much gone, down to 1.2. 4.75. Which was basically two cuts by the end of the year. Half the market, almost half the market was thinking that, 44.7%. under 10% now. So the market is getting it. When we look at the Fed funds futures curves, we'll see that it is flattening out. Effective federal funds rate 5.08, reverse repo down 87 billion. And what I'm going to start doing is putting lags down here, a 6-month lag. These are months, 6 month, 12 months, 18 months. So looking back 6 months ago, what was the effective federal funds rate? 3.83. 12 months ago it was 0.83. 18 months ago it was 0.08. This is if we assume that monetary policy works with a lag, if we say, well, on average it'll work with a 6-month lag, there is still 125 basis points of effect still to feel. The effective federal funds rate is 5.08. 6 months ago it was 3.83, and if we think, well, it takes 6 months to filter through, then 3.83% of that is already being felt. There's another 125 basis points left to be felt in the economy. So, the narrative seems to say, look, we've raised interest rates 500 basis points and companies are still okay. Well, yes, you've raised rates and companies are still okay, but have companies felt 500 basis points of hiking yet? Or have they only felt 383 of it? If we assume a 12-month lag, 12 months ago, the effective rate was 0.83, which means there's still 425 basis points of effect still to be felt. And if we think, well, it's 18 months, then there's 500 basis points to be felt, which means that of the 500 basis points that were raised, the vast majority, well, almost all of it, 100% of it, has yet to filter through to the real economy. Well, that's not exactly true. We know some of it has filtered through to the real economy. Not 100% of it. The economy is not feeling 5.08 right now, but it's certainly not feeling 0.08. So, you can sort of use your own subjective judgment and think, well, we know it's not 100% because we know that companies use interest rate swaps. We know that households have fixed rate mortgages. They're not feeling the increase in the interest rate. Those with floating rate debt and credit cards may be feeling it. But for the most part, the biggest debt households usually have is their mortgage. Many are sitting on fixed rate mortgages. Most companies floated bond issues in 2020, 2021 when rates were super low, and they're sitting on low cost debt right now. Even now, there's record issuance for May. In both high yield and investment grade, it's the highest of the year and it beats last year. And it's going out at rates that are fairly competitive overall, considering that it's debt and you have the interest tax shield associated with that. That to say that 100% of the rates have found their way into the economy, I think is a false statement. To say that none of it has found its way in is a false statement. So I think you're somewhere between 125 basis points and 425 basis points still to hit the real economy at some point, along with the real possibility that you're going to go another 25 basis points in June. Okay, real rates have all increased. Look at the 5-year up 22 basis points, the 7-year up 16. They've all increased, which usually is negative for equities, negative for cash flows, because that's the bigger part of the discount rate. 179 to 157, you have an inversion here. I think that's the deepest inversion so far from the 5 to the 10 on the real yield curve. Break-even rates, you can't really say too much has happened there. Fed fund futures, lots of activity over here. It doesn't look like it's flattened out, but you have to look at the amounts on the side of the chart here based on what the range was last week. That if I overlaid this chart on last week's chart, it has flattened out significantly. Last week the index was bottoming out in August at 94.87. Now it's 94.665. In other words, 20.5 basis points higher on the implied rate, 5.335 as opposed to 5.13. That is reflecting the middle of a range of 5.25 to 5.5. So the federal funds futures curve is suggesting there is one more hike coming up. If we move over to December, last week was 95 27, now it's 94.93. So the implied rate went from 4.73 to 5.07, an increase of 34 basis points. And the drop from August to December is only 26.5 basis points. Last week it was 40. The week before that was 59.5. I'll move this over a bit to get that on the screen. It was 59.5. Going out to March, it was 95.63. Now it's 95.21. So the implied rate went from 4.37 to 4.79, an increase of 42 basis points. So it is coming out of the futures curve. For 2024, the difference is a drop of 145 basis points. Last week was 133. I got the last 6 weeks down here. So it is expecting more rate cuts in 2024 this week than last week, but fewer this year. Looking at TLT for the week, even though it had a lot of activity, basically ended unchanged. It ended last week at 101.10 and ended Friday at 101.09. The difference of a penny, but gave us some nice implied volatility. 42% on 13-week. Which is why, I was trying to pick up the 105 calls for March, and I kept bidding 5, 25, 25, and even though TLT kept going down, the premiums weren't coming out, and that's because the implied volatility was rising at the same time. So currently, here's what my position looks like. I've got 60 January 24 110 calls, and I'm short the 115 calls for a spread. I don't think I'll be closing out the 115s anytime soon. And I have 58 June 23 104 puts. I will add 40 to 60, I'm not sure. March 24 105 calls, looking for around $5. If we have a 25 basis point hike coming in June, if that probability increases, I think I might be able to get it for $5, but I'll keep watching it. It is purely, at this point, it's purely a recession play, because if something breaks and it's significant enough when it breaks, the Fed is going to have to cut rates aggressively. And if they do that, there's your winner on this one. Beyond that, if TLT is put to me, I've got these are now free. In fact, I cannot lose on this trade, so I can pretty much cross this trade off and say, well, I don't have to worry about that. I'll either win on it or win more on it. Either way, that's a done deal. I've sold these puts, and if the underlying is put to me, I'm okay holding it because I can always sell calls against that position. I'm okay holding it. And then this is the next one I want to open up. Once I open that up, I will then start working the premium off using puts to get that for free. Or if there's a nice rally at some point, I may say, well, why not sell the 110s or the 115 calls on those. How I'm going to do it, I don't know. I will let the movement in the market tell me what my next play is. Looking at credit spreads, generally uninterested in anything that's going on. Just no information content in there at all. All of them have decreased over the course of the week. I heard a report on Bloomberg, private credit has a total of 11 trillion under management. 8 trillion is deployed, and there's 3 trillion sitting around waiting to be deployed. And the argument is that maybe we're overestimating the downside on commercial real estate because private credit can step in. Well, okay, so private credit can step in, so maybe we might be okay on the existence of commercial real estate, but private credit is not going to step in to save the bank. And is not going to step in to save the equity holders. Private credit is going to do its own thing. It wants the maximum that it can get. It is not going to step in and protect all the shareholders and protect the bank. It's not a savior. Okay, it's a shark. So yes, there's 3 trillion sitting around, and yes, that could be deployed. but that's going to protect the properties. And if you're in private credit, you'll do quite well, probably, buying those properties or lending money to those properties at nice high yields with a very good position. But they are not going to step in to bail out banks and bail out shareholders. And that's why I continue to be negative on that space. Looking at the 1 to 3 year IG 564, that's not bad. The OAS there 96. If we look at the 1 year, the 2 year, the 3 year, and we equally weight them, you get to 96.67. And that's pretty much where it is. And you can see it's been hanging out pretty much in the 90 to 100 basis point spread for the IG. 30-year fixed rate mortgage up to 6.57, 18 basis point increase week over week, which was negative for the home builders. You can see the home builders pulling back here, which it's hard to pull apart. Are they pulling back because mortgage rates are going up and there'll be fewer buyers, or are they pulling back because they were so far extended above their 200-day moving average? Either way, they are pulling back, which is a nice opportunity. U.S. 10-year Treasury from the 18th to the 25th increased 18 basis points in line with the 30-year fixed rate mortgage. So the spread is unchanged, but that didn't save the mortgage REITs. Agency down 1%, Annaly down 3.6%. They were down much more than that, but had great Fridays. On Fridays, they rallied significantly. Arbor, week over week, up 2.76%. IYR down 1.34%. I have the January 24 synthetic short at 80 for a premium of 511. I closed 50% of that at 80 cents because the AI thing just kept going, and IYR does have data center REITs. And so I got some exposure to Prologis and to Granite, which is a Canadian data center REIT. And they both performed in line with the AI hype on Friday, and I think they'll continue to perform in line because they're the suppliers to all the hype companies. The hype companies may not be profitable, but these guys are. And there's a good parallel with what was going on in the late 90s to the suppliers to the .com. They tended to be the more predictable winners, although not the high-risk winners. So because the IYR has that component in there, I'm not shorting anything that throws around the name AI at this point because it's gonna have momentum. It has data centers, not enough, I think, to bring the IYR back to where it was before, but could it see 85, 86, 87? Yeah. So I took half my position off. I could be wrong, but I'd rather take the profit that's sitting there rather than watch it go away. Now, it could continue on. Well, if it does, I still have 50% that will be in the game. But if not, well, as Friday was unfolding, it was the right thing to do. So I didn't have any concern going into the end of Friday. Home builders have pulled back. DHI 3.16, Lennar 5.4, Toll Brothers added, and so did Hovnanian. Toll Brothers 2.53, Hovnanian 1.99. Pulte down 4.78, KB Homes down 1.87, HXB down 2.01. I still have puts, sold some puts on XHB. I've got the 70, 50, the 69. This expired. Every week I roll one over. When this expires, I'll do another 30 delta every week, 2 weeks out. Toll Brothers, I got 60 puts, Pulte 64.50, Lennar 105s, DH, I've got the 106, the 103s, KB Home, the 41. I would love them to keep pulling back. I think this is just a great opportunity to add more because you still have a structural shortage of housing in the U.S. and existing homeowners are probably the last to start listing their houses with a 3% mortgage, only to get into a new one at a 6.5% mortgage, right? So I think that's locked. That supply is locked for a while. Mortgage apps down 4.6%, refis and purchase index both down. New home sales month over month for April up 4.1%. New right? Pending home sales down 20.3% in April. That is year over year. If you look at month over month, it's flat. So it's not getting worse for the pending home sales. This will include, this is for existing pending for existing home. It is in some process of closing. An offer has been accepted, but it hasn't closed yet. It's pending. But new home sales, which is bullish for the home builders. So, I don't know what it is on the home builders that did it. It was due for a pullback. I mean, you can only hit 52-week highs so many weeks in a row before you start saying, okay, I think we're all in. And like I said last week, everyone seemed to be talking about home builders. It got to the point where almost every guest, what do you like? Well, the home builders. It's like, well, okay, everyone's saying that now, and that's why last week I said I'm not too sure, how aggressive I want to be at these levels, being that you're so far extended above all the 200-day moving averages. I'd like to see deeper pullbacks in both DHI and Lennar. If you're going to be in this sector with high interest rates, you want size. Because there are scale economies with size, and those are the two big guys. Okay, PCE. Got to talk about that because no progress. In fact, it fell in line with CPI, came in higher than last month. So it is going back up. And if you look at where rents are going, they're going back up at a considerable pace. So we'll look at the rent index. This is from Zillow, the rent index for a 1-bedroom and 2-bedroom. But let's look at PCI here. 0.4 PCE, this is the price index. PCE 0.4, excluding food and energy 0.4. So excluding food and energy for 0.4, if you look at what we have here, last 5 months, 0.4, 0.6, 0.4, 0.3, back up to 0.4. That's pretty much sideways movement. Same down here, percent change from a month 1 year ago. PCE excluding food and energy 4.6, 4.7, 4.7, 4.6, 4.7. That is sideways movement. This is interesting here. If we look at disposable personal income, up 0.4%, but adjusted for inflation, chained $2,012 flat. So real incomes are flat. We look at the personal consumption expenditure, what they spent, up 0.8, adjusted for inflation 0.5. So real incomes are flat, but real quantities are up 0.5%. So they must be relying on increases in credit to get that done. And your price indexes are not going to give evidence to the Fed that inflation has been coming down, which means when they say we need to see it drop for a sustained period of time, that sustained period of time hasn't even started yet. So if you're thinking about a timeline going, well, okay, a sustained period of time, they're still at the starting line going, we're waiting for it to start. Once we see it start, then we'll say a sustained period of time, maybe 6-7 months. But we haven't even started that. Everyone's still at the starting line. Look at the rent index. This is a month over month, April over March. 1-bedroom up 0.6. That's a 1 month increase, 0.6%. If you annualize that, you're well over 7%. For a 2-bedroom apartment, it's up 0.8% in April over March. And this is consistent with other sources of information and with Canadian information as well, that rents are going up. When I looked at the Canadian apartment REITs, you'll recall I'm out of REITs altogether, but the Canadian apartment REITs, I didn't think that they could pull off much NOI growth, because you keep hearing, well, rents are flattening out, and they all had like 98, 99% occupancy. Well, if rents are flattening out and they're pretty much at occupancy, where's NOI growth going to come from? And they were running 9 to 13% NOI growth. So there's no way rents are topping out, not with NOI growth at that level. So I'm going to look for some weakness in the Canadian apartment REITs, and I think I will get back into them at some point. But it's going back up. And it just, it didn't make a lot of sense that if you have a housing shortage and mortgage rates are this high, how is it that there is no price pressure on rents still? I mean, what's happening? Are people just moving to tent city at that point? It just didn't make a lot of sense. So, here we are. For the consumer, if we look at interest payments, because we do have that as part of the spending, interest payments as a percentage of their personal disposable income is running 2.27% of their disposable personal income, up from about 1.5%. So has the full effect of 500 basis points of hiking been felt by the consumers at this point? Not really. So this is a chart of choice properties. They have hotels. And Friday, Bloomberg was cheerleading AI all day long, and they were saying, coming up on Bloomberg, CEO of Choice Properties to discuss how they're using AI. And I think he showed up about this time and just, AI. Hotels. Choice Properties, hotels, we're going to use AI, and it didn't matter. While it was going on, if you just looked at the chart at this point in time and you saw that, you're going, well, look, everyone's just saying the words AI right now, or the letters AI, and they're getting an AI bump. And then, after that was over, I think the market came along and said, well, hang on a second. It's just ridiculous. I mean, it's a hotel, for God's sakes. What's it going to do? So down and down it went. What I'm finding is, there is some enterprise resource software that's always been around that does a lot of work in terms of forecasting, planning, room rates, things like that. Well, if you've had that in place, well, why not call that AI now? Why not say, hey, that's our AI? So that you have some companies that are calling their enterprise resource planning software, which has been around for a long time, they're now saying, hey, why not just call it AI and get a bump out of that? So when I saw this run up here, and look at these gaps in the price, it just was gapping. Like, these are called runaway gaps. It was like, this is ridiculous. I mean, how many companies are just saying AI now for the sake of saying AI? But then some rationality came in the market and said, oh, okay, hang on a second now. That doesn't look like it's real, and it went away. But you just can't ignore that effect. Okay, we're going to spend some time on this screen because this, to me, is the story. And I'm not going to do the SPY chart this week with the levels. I mean, what would be the point? The earnings really haven't changed week over week. We know where we are. We're sitting right at the 4,200 level. We've got a potential deal on the debt ceiling. AI is just on fire, and the flavor is much like 1998, 1999 again. So we'll spend some time comparing the two. I just don't know that there's much value in looking at where the index is right now because I don't have any clarity. We will look at our calendars, but let's look at what we have here. I was watching Wall Street Week, and this chart came up. So I hit pause and took a screenshot of this because this tells just an incredible story. You've got two price lines here. You've got the S&P 500 in white, and you can see it sitting, pushing upwards there's the 4,200 level, and it looks like it wants to break the 4,200. And then you have the S&P 500 X the AI boom stocks, just a little under 3,800. When I saw that chart, I hit pause. I said, oh my God, look at that. There's the hype right there. If you take out the AI boom stocks and you just look at the S&P 500, which you're basically taking out 7 stocks, and it is 3,800. Now those 7 stocks I've got listed on the side here, they make up 24.68% of the S&P 500. In fact, the top 10 stocks in the S&P are 35% of the index, 35%. So when I'm shorting the S&P, it occurs to me very clearly here that I'm shorting 10 stocks. 10 stocks that are under momentum, and you never short momentum. So I have to get neutral very quickly, I think. These 7 stocks are 24.68% of the S&P 500. The S&P 500 is up 10.29%. 10.29, so that if you reverse the 10.29, you get to a little bit higher than where the S&P 500 x the AI stocks are. In other words, 100% of this rally this year, 100% of the S&P is 7 stocks. The other, and there's 505 stocks in the S&P 500, by the way. 505, not 500, but 505. That's an odd number, but you don't want to call it the S&P 505. So there's 505. So the S&P 498 has gone nowhere. The S&P 7 are up almost 80, 90%. So combined, that puts the index up 10.29. Look at NASDAQ, year to date. 31.73%, 31.73. Let's look at some individual names. Microsoft. This is just year to date, by the way. Microsoft, 38.95. Google, 39.83. Meta, 110%. Amazon, 39.96. Apple, 40.27. Nvidia, 172%. Tesla, 78%. And those 7 represent 24.68% of the S&P 500. Marvell, which is another chip maker, up 82% this year. In the late 90s, the dot-com really, October 98 to March of 2000, was the boom period for dot-com. In 1999, the NASDAQ was up 86%. We're in the first 5 months of 2023, and the NASDAQ is up 31%. The winners, the big winners that were supplying the dot-coms at that time, Cisco, Dell, Intel, Microsoft, they all had real revenues. All the dot-coms didn't. They all had real revenues. They were on fire. They were in everybody's portfolio because they were supplying the prospectors. You know, you can think about picks and shovels. If there's a gold rush, you want to be selling picks and shovels because you're going to make money, but you may not strike gold, right? But everyone's got to buy picks and shovels. So these were the companies that were selling picks and shovels. Well, today you need data centers and cloud-based companies, Microsoft, Google, Amazon, and you need chip suppliers. There's your Nvidia and Marvell. And then you have some companies that have real revenue saying, hey, we're going to use AI. There's your Meta and your Tesla in there as well. And then when you move to the dot-coms, any dot-com, they didn't have revenues. They had eyeballs. And this was the age of new metrics. Because nobody really understood, well, what will the future be? Because all the stories begin, oh, well, this will happen and you can do this online and this will disappear and, there'll be no need for malls or retail stores. You'll have virtual malls. There were these things called virtual malls where you could show up at this place and it wasn't a mall. It was just a listing of other websites that were retail websites that you could shop at. And that was the belief that everything's going to move here. It's going to be super scalable. You won't need all those location. Margins are going to be great. The growth is going to be fantastic. And there was not a lot of growth in the real economy, but there was a lot of asset price speculation going on. So this created a massive bubble because these companies every quarter, they were burning cash like crazy, but they were reporting, hey, our eyeballs are up this much, our clicks are up this much, this is how many page visitors we got, this is how many page clicks we got, and it was all in the millions and the hundreds of millions, and this is going to be great. VC investment just ran into the space, didn't really care. Money was rushing in to that space, and it was, we got to get a .com. We got to get some .coms in our portfolio, and that's what's going on with AI right now. I was listening to the All In podcast, and these are VCs in the area, and they're saying, there's two sides to VC right now. There's everything else that's not getting funded, and there's AI. That sounds like 1999 to me. There's everything else that's not getting funded, and there's .com. This did not end well, by the way. NASDAQ dropped 77% from its peak, all the way down to October of 02. So March of 2000, it peaked, and it took almost 2.5 years to lose 77% of its value, and then 15 years to recover that peak. So if you bought it at the peak and you said, well, I'm going to hold it till I recover, it was 15 years of dead money. This is there are some big differences in what's going on now. In the late 90s, .coms were separate businesses that were starting up with no cash flows. They were just separate businesses. The bricks and mortar company saying, well, we'll open a website, really never helped them. The idea that they were going to open a website never really helped. Even 2003, 2004, Blockbuster was saying, okay, well, we'll do some online video rentals, much like Netflix. Never really caught on. Walmart even wanted to get into that game. Never caught on. They quickly abandoned it. So it just, the traditional companies that said they were getting in on that never really helped them. But now AI is not really a separate business. AI is a tool that you use within a business. It's a kind of a different flavor. So while the companies in the late 90s, these .coms had no revenues, the suppliers were real companies with real revenues. Much like NVIDIA and Marvell and Microsoft and Google, cloud-based companies and chip-based companies, Prologis and Granite are the data centers. These are real businesses supplying that euphoria. You do have some AI startups that are working on some generative technology, but a lot of it is being deployed within existing companies that already have huge amounts of data, saying we're going to use this company's AI or this generative AI. And every company seems to be getting an AI boost. And it's in the 90s, it was buy now and let's just figure it out later. Let's buy these .coms and we'll figure it out later. We'll figure it out. So right now a company says, well, here's what generative AI is doing for us, and we see this kind of savings. IBM is saying like 30% reduction in headcount in back office. They've they've frozen hiring in the back office because they're saying generative AI is doing incredible things. I've used it here. I have the subscription for GPT-4, and it can do certain things very quickly. So if you wanted to write an email for you, you could say, write an email with these points, make it semi-formal. And it'll give you a first draft that might save you 10 minutes drafting it yourself. So I'm already seeing that even I can use it for little things like that. So the potential is there, but it's going to take I think several years before it really starts to show up, because it's not perfect, and well, neither are humans, right? It is subject to errors. I know that I ask it questions that I already know the answer to, finance questions, and I'll read the answer, go, no, that's not right. If you say, who is Mark Meldrum? It will tell you who I am, but include a whole bunch of things that I am not. So I read it and go, it's not right. That's not correct. So I don't know that I want to bet money or people's lives on it yet. But that doesn't mean it's not going to get better and better. And that's the hype right now, is where's it going? It's going to get better. It's got all this promise, 30% growth on GDP by 2030. It'll increase margins by 400 or 500 basis points. So we won't have 11% margins as a percentage of GDP anymore. We're going to be at 14 or 15. So that narrative is out there. Being short the S&P 500 means I am short these 7 stocks that are just under momentum at this point. So for the S&P to go down in the face of this momentum, the other 498 have to drop considerably. I just don't see that if you take out the high flyers and they're already sitting on under 3,800. I'm just not seeing that they're going to help me a lot. So I've got to get neutral. And getting neutral means I roll up my puts because I've got a lot of downside protection, but my break even is sitting somewhere around 42.90, which isn't very far from where we are now. So if I roll up my puts, all my puts by 100 points, I can get my break even up to 43.90, and my break even on the downside from 38.90 to 39.90. I'm probably going to start doing that this week. Here's the other difference, and here's where I'm a little uncertain. Here's the other difference between the late 90s, this dot-com mania, and where we are now. In the late 90s, inflation was coming down. The central bank was cutting rates. This is in the aftermath of long-term capital management. So the central bank had been easing monetary supply. You had a booming economy otherwise under Clinton. You had, I think, 2 or 3 years of budget surpluses, government debt coming down. You had all the conditions under which the economy should continue to perform well. Well, we don't have that now. We have central banks that are tightening, still tightening. You have inflation that is, well, it's not coming down. If we look at last month's, the CPI and PC is actually going back up. Rents are going back up. So you have a different economic backdrop today than you did then. You also, I think, have some investors that are a little bit wiser when it comes to euphoria, saying, we've seen this before. However, it could be that institutional investors say, let's not underestimate the willingness of the retail investor to jump on board. And that institutional investors may not be buying the market because they like the valuation. They may be buying the market because they know the retail investor cares little about valuation. And we'll say, well, we expect a wave of AI euphoria for the summer at least. So we'll buy this market for no other reason than the retail investor doesn't care about valuation. But we do. But we can't ignore this because, well, we have benchmarks. So I think there's, if I look at this, I think there's good reasons why this is not the same as 1999 from an institutional investor perspective. There's good reason why this is not 1999, but I still would say that the data centers are still an okay place to be, and the providers to the AI space are a good place to be. I don't know who the AI winners are, but I don't know that the retail market cares. I think they're just going to see that the market is going up. They're going to see Marvell. They're going to see Nvidia. They're going to see Tesla, and money's is just going to start coming in to those names. So, if I were a betting person, I would be betting on the unwillingness of the retail investor to consider valuation, which means I'm not betting on the market. I'm betting on the retail investor. So I think I'm going to get neutral during the course of the week. I'll see how the week plays out, but Globex opens, even though Monday's a holiday, Globex still opens, and Globex will still have futures trading because other markets are open. The Canadian market is open, the European markets are open, so it's all of the Treasury futures and the equity futures. Since they're hedging instruments, they're going to open up everywhere. I'll see tonight how we open up. It would not surprise me if there is no bad news that the deal is falling apart that we had last night on the tentative deal. It would not surprise me to see futures up 50, 60 points at 6 o'clock. So my puts will have earned most of their money. So at that point, I would probably start rolling up my puts at that point to get as neutral as I can. I'm gonna review the economic calendar coming up. There's not much on the earnings calendar. I don't know that it's worth looking at that, but you know how to find that in the spreadsheet on the last page from S&P Global. We'll review the economic calendar, but we'll leave it here this week because I think right now there are only two stories, and I don't know which one wins. There is the Fed, and I'm not sure the market cares anymore, and there is AI, and I'm not sure the money coming in cares about valuation. Now, when you have those two things, you cannot stand still. You have to play the market you got, not the market you want. And right now, I don't got the market I want. Okay, so three themes going on. You've got the debt ceiling. That is a tentative agreement, and what'll dominate the calendar this week is the vote. And when the vote will be. McCarthy says he wants to give his people 72 hours to look at it. So if the tentative agreement was reached Saturday night, let's say they have a draft of it Sunday night, you could be looking at a vote Wednesday night or Thursday morning. If everyone's on board, it could be going to a vote this week before the end of the week. So that'll be important to watch, because I'm sure once it's voted on, there'll be yet another relief rally. On that one, right? At every step of the way, you have to have a relief rally. Every time you get the same information packaged in a different way, you must have a relief rally off of it. The second theme is the Fed, and this week is a jobs report week. Lots of information coming out on the job market. And the third theme is continued AI excitement, right? So what do we got? We got nothing going on Monday. Tuesday, you have consumer confidence. Going into Wednesday, earlier I said that the JOLTS report was Tuesday. It's actually Wednesday. Sorry about that. There's JOLTS for the jobs report. For our Canadian friends here, you have GDP growth for Q1. Some Fed speak here, and there's the beige book Wednesday afternoon. Going into Thursday, ADP. The always wrong ADP, but somehow every month it comes out, the market seems to react to the always wrong ADP. You have jobless claims, and you're going to get the final look at non-farm productivity. It's going to be negative. It's been negative for a while, non-farm productivity, which means if you have that negative, it's going to make your unit labor costs higher, because you have higher ECI. The employment cost index is up, but your unit labor costs could be down, like only up by 2%, let's say, if you have positive productivity. If you have negative productivity, not only are you paying more for your employees, but those employees are now producing less. So your unit labor costs are increasing. That's what we want to pay attention to and see where that is headed, because that is margin related, right? ISM manufacturing, going into Friday, you have non-farm payrolls, and the number to look here, at least the one that I'm more interested in, is the participation rate. See if that's going up. Average hourly earnings, I'm not that excited about, although the market does seem to react to it. So if it comes in higher than expected, it could be a negative, but if it comes in lower, well, I think it probably just changes the probabilities slightly for June. I don't know if all of that is enough to overcome the euphoria of AI. If you get a vote and the debt deal looks like it's going to happen, that's going to be seen as a positive, not a neutral. It's not going to be seen as the removal of a negative. It's actually going to be interpreted as a positive and something to rally on. AI will continue to be something to rally on unless the market says, no, we've seen these bubbles before. These valuations are ridiculous. It's another bubble. It's 3, 4, 5 years down the road before these gains in productivity really start to show up. Maybe that can happen. I don't know. And if AI is all the talk of the town, no one's going to care about the Fed anymore, because they'll convince themselves that it's almost over. Okay, so there's one more. It's almost over. So it'll be one of those, yeah, but, hey, AI. The Fed's going to raise rates. Yeah, but AI, it'll just be AI. I hear you talking, but I'm not going to listen to you. I got a feeling that is starting in the market, because Friday was just watching what was going on Friday. It just seemed that nothing mattered other than this story, and it reminded me of what 1998, 1999 was like, where. And I'm not kidding you. Every week you had a growing chorus saying, that's it. We're so overextended. There's gonna be a pullback. You gotta fade the market here. You gotta be short, and it just went up the next week. And then those the bears just got punished and punished and punished, and everyone agreed that it's gone too far, too fast, and this is ridiculous, and it just kept going. Ridiculous got more ridiculous, and when you got more ridiculous, it got even more ridiculous, until it finally broke, and then everything broke very, very quickly. And that's momentum. Momentum is your friend until the end. That's, I don't know where I heard that, but it's a nice little rhyme. Momentum is your friend until the end, because when momentum breaks, it breaks hard and fast. So if you're gonna follow any of these rallies, my recommendation would be use spreads. Don't buy NVIDIA, buy a call spread. Because, and let me go back to a screen while we're here, and I'm just going to create a new screen. I'm not going to edit any of this. If we look at the distribution of skew for many of these AI-related stocks, it wouldn't surprise me if you had this going on, where you had huge upside on calls, nice implied volatility on calls. Well, if we look at the distribution of what that would look like, if you had common IV across all strikes, these are puts over here, these are calls over here, that if you went a certain distance above the at the money and below the at the money, you would find that the put and the call would basically be the same price if your interest rate is zero. I'm just trying to get a point made here, even though we know it's not zero. This is what you would see. When you have this kind of skew, here's what you have. You have something that looks like this. So what happens is call spreads become really cheap, because you're buying an at the money call and a call over here. They become really, really cheap. And what happens with your puts is they tend to do this. So a put spread becomes very expensive, right? Call spreads become very cheap. So if you're going to play any of these names, do it with call spreads, because you have defined risk at that point. If you're doing a call spread and you pay $500 for the call spread, that's the most you can lose, is $500. But if you sell puts behind it, and the market is too smart this time, saying we can smell a bubble, and no, we're not playing this game. If it turns around, it could really, really hurt you. So I don't know that you want to sell puts on any of these names. I don't know that you want to buy any of these names at these valuations. If you're going to participate, do it with call spreads, or do it with 0 day to expiration options, where you could just bet a little bit for the day. If you really feel the need to be in the game, do it that way, but resist the urge to buy this stuff. I think if you want to add call spreads, which is on NASDAQ, you could do that with the futures as well, as you can do a call spread with the futures on options, and you'll be able to get that done Sunday night. You don't have to wait till Monday morning to put your call spreads on if you have access to Globex and you're willing to use the NASDAQ as your underlying. For the futures, the multiplier is 20 on NASDAQ. It's 50 on the mini ES, 50 times. But this is just a spread. So you'll pay something for the spread, and you'll get some big upside leverage on that. That is, if I were going to get exposure to it, that would be the only way that I would do it, is using call spreads. that is it. I really don't think it's worth analyzing the chart of the S&P 500 at this point, because it really is two markets. It's not one index. There's one index of the S&P 498 that seems to be doing nothing and going sideways, and there's another index called the S&P 7 that will crush you if you try to short that momentum. Anyways, let's see what happens. As I said at the very top of this video, if we went up 100 points, I'm not surprised. If we go sideways, I'm not surprised. If we go down, I'm not surprised. I have maximum uncertainty at this point in time.